So ESG investing has been in the news a lot recently. And like politics, it has people taking sides and making some big claims as to what is right or wrong with it, whether it's good for investors, whether it's good for the planet, or whether it's just a passing fad. The ESG funds have boomed in recent years, exceeding $350 billion in net assets in 2021 in the US alone, as investors are looking to fund companies that are addressing climate change and other issues. But murky disclosures and lax standards around reporting are driving regulators to tighten the rules. With the growth has come a chorus of both promoters and detractors in terms of ESG investing. So what is ESG investing? Well, it grew out of something called SRI, or socially responsible investing, and also CSR, corporate social responsibility. The idea is to promote positive behavior by using capital investment to reward companies that are doing good and to influence companies that aren't to do better. Of course, whose definition of good is really the trillion-dollar question. If you look at the different categories, you can see that there's a lot of different ways investors could define E, S, or G. Environmental, climate, air quality, water quality, social factors might include things like diversity in the workplace, child labor, and in governance, it might have something to do with how much corporate executives are paid, what kind of people are on the corporate board, and how policy decisions are made. These categories set up a very wide range of views and targets. Now, MSCI is a market research company that gathers whatever data it can and then scores companies on various ESG-related metrics. These allow ranking systems and filters to be established so investors can customize their portfolio holdings based on their values or what's important to them. The hope is that an investor would make it harder for offending companies to raise capital and easier for investors to profit from companies whose ESG profile they like. Now, there are some big differences between these methodologies, but the data used to create the company ratings has some problems. These problems relate to how confident an investor should be about whether they're really doing the good they intend. It's hard to have a high degree of confidence in the data currently. In a survey conducted in the US and in the UK with results that were released in January, you can see the very low percentage of companies providing clear and complete data. One problem with ESG investing is the availability of information. The data is not universally available from all companies. Oftentimes it's self-reported, and if the data reported, that self-reporting may lead to some instances of bias in what's available for the investment companies to create the scores or for investors to really know what it is they're investing in. The SEC in the United States and the EU regulators are trying to come up with rules that would allow for more uniform scoring and ranking, but as of today, those rules and regulations don't quite exist. So given what we know, what investor goals can be pursued, which is desirable, and what does the data support today? A couple different ways to phrase it might be, do you want to do better by doing good, or is doing well enough by doing good suitable in terms of your financial goals? In a recent presentation of research results by University of Chicago finance professor Lubos Pastor and his team, they made some observations about what ESG currently means for companies, shareholders, and society. One of the questions is whether ESG investing should generate higher returns over time. Of course, there are two reasons to hope that the answer to that question would be yes. One is investors like the idea of being rewarded for wanting to do the right things. And investment companies, they would love to be able to sell higher returns by saying, hey, if you invest in these ESG funds that we're putting together, you could expect a higher rate of return. But what did the professor and his colleagues find out? Well, they think that financial market theory would say that long-term higher expected returns are really not a reasonable expectation for ESG investing. Now, why is that the case? Well, a couple of things to be aware of. Currently, demand for ESG investments, which ultimately drives the price of those assets, it's very high. The higher an asset price, it tends to shrink the future expected return. Additionally, an investor will often have to give up a level of diversification to invest in some companies that they really like at the exclusion of other companies that they don't. That loss of diversification has a potential negative impact on risk-adjusted returns in the portfolio. This is not to say that investors should not take an ESG position in their portfolio, but that investors should at least have a combination of both financial and non-financial reasons for ESG investing. A reasonable expectation is that returns may be similar, but not equal to the broader market, because currently there's no conclusive evidence of a positive ESG factor, one that offers systematically higher expected returns on capital. So there's a small data set available, a short history, and of course, a limited amount of data, even the self-reported data. It just works slightly against basic laws of market supply and demand. However, it is very possible to do well enough financially by attempting to do good with your investments. By well enough, we mean getting market-like returns with potentially small increases in risk due to loss of diversification. Just to show that data can be made to support whatever story you like, though, here's a story that says the broad market outperforms ESG approaches. Looking at the last year, both of those ESG leaders and the ESG screened index are underperforming the broader global market over the last 12 months. But if I change the time frame, it looks like the broad ESG framework can look like the winner. Now, why might this be? Well, both the leaders and the screened indexes we just looked at, they underweight energy and they overweight technology due to their scoring systems. Now, during the pandemic, technology, the yellow line, was obviously the winning sector, contributing strongly to an apparent ESG win. But during the post-pandemic recovery and into 2022, energy is doing better than technology. So is the return story here really a broad ESG story or really a specific sector story? It's hard to say with any confidence, given the number of variables in the global market. But investors should be able to see that they can do well enough pursuing a diversified ESG strategy if they also have non-financial reasons that cause them to favor that approach. Both of these ESG indexes own a broad enough exposure to the global market that their returns are highly correlated with that global market. The key here in putting together your portfolio is to understand who your asset managers are and what choices you're making in the funds that you own. You want to know whether that asset manager is making decisions that match your expectations. The combination of incomplete and inconclusive data and the statements by individuals, especially by BlackRock CEO Larry Fink, have caused some large institutional investors to fire asset managers who are either not transparent or not clear about their ESG actions, or they're maybe taking actions that an investor doesn't feel like fits within the scope of the original mandate that they hired them for. It's not necessarily right or wrong as long as the manager is transparent about their intentions and actions, and they're consistent in both of those things. It's really up to the investor to make the choice as to what kind of manager they want and which ESG profile they either want or don't want in their investment portfolio. So if you have an interest in ESG investing, here are 3 important steps or considerations to make. One is you really need to define your goals. Do they include both financial and non-financial goals? And those can be equally important to investors who are considering what to do with their investment dollars. Then you really want to understand that the ESG marketplace is very diverse and the data is inconclusive. So you want to spend some time understanding what it is that you're targeting and who might be doing a good job of that. And finally, you want to choose your managers and your funds carefully. You want to require transparency at every level as you examine which things make it into your portfolio and whether those assets in your portfolio are actually aligned with those non-financial goals that you've set. So there's a lot more that we could talk about with ESG investing. I'm sure there's going to be more to come in the future. Hopefully this gives you an idea of where to start. If you have more specific questions, we would love to hear from you. Here's some contact information, some ways you can get a hold of us to pose more questions. We'd be glad to do that in future versions of Financial Perspectives. Thanks for watching.